Hi everyone, welcome to my channel, where I share tips and insights on the 4 pillars of money management and personal finance. In today's video, I'm going to talk about NFOs, or new fund offers, which are the initial public offerings of mutual funds or other investment vehicles. NFOs are often marketed as unique opportunities to invest in new and innovative themes or strategies, but are they really worth it? How can you decide whether to invest in an NFO or not? Well, in this video, I'm going to share with you 3 questions that you should ask before investing in any NFO. So, let's get started. Question 1. What is the objective of the fund? The first question that you should ask before investing in an NFO is what is the objective of the fund? The objective of the fund tells you what the fund aims to achieve, how it will invest, and what kind of returns it expects. The objective of the fund should be clearly stated in the offer document, which is the legal document that contains all the details about the NFO. You should read the offer document carefully and understand the features, risks, and benefits of the fund. You should also check the fund manager's profile, experience, and track record, as they will be responsible for managing your money. Some NFOs may have a very specific or niche objective, such as investing in a particular sector, theme, or geography. These funds may offer higher returns, but they also carry higher risks, as they are more exposed to market fluctuations and uncertainties. You should assess whether the objective of the fund matches your risk appetite, investment horizon, and financial goals. You should also compare the fund with existing funds in the same category and see how they have performed in the past. Question 2. What is the cost of investing in the fund? The second question that you should ask before investing in an NFO is what is the cost of investing in the fund? The cost of investing in a fund includes the fees and expenses that you have to pay to the fund house and the intermediaries, such as brokers, distributors, or advisors. These costs reduce your net returns from the fund and affect your long-term wealth creation. One of the common misconceptions about NFOs is that they are cheaper than existing funds, as they offer units at a nominal price, often 10 rupees per unit. However, this is not true, as the unit price does not reflect the actual value of the fund. The actual value of the fund is determined by its net asset value, NAV, which is the market value of its assets minus its liabilities. The NAV of the fund is calculated after the NFO period is over and the fund starts trading on the stock exchange. The NAV of the fund may be higher or lower than the initial offer price, depending on the performance of the fund and the market conditions. The cost of investing in a fund is not determined by the unit price, but by the expense ratio, which is the percentage of the fund's assets that are used to cover its operating expenses, such as management fees, administrative fees, marketing fees, etc. The expense ratio of the fund is also disclosed in the offer document and it varies depending on the type and size of the fund. Generally, the lower the expense ratio, the better it is for the investor, as it means more money is left for investment and returns. You should compare the expense ratio of the NFO with that of existing funds in the same category and see if it is competitive or not. Question 3. What is the exit strategy of the fund? The third question that you should ask before investing in an NFO is what is the exit strategy of the fund? The exit strategy of the fund tells you how and when you can redeem your units and get your money back. The exit strategy of the fund depends on its structure and features, which can be either open-ended, closed-ended, or interval. Open-ended funds are those that allow you to buy or sell units at any time, at the prevailing NAV. These funds offer high liquidity and flexibility, as you can enter or exit the fund as per your convenience and market conditions. However, you may have to pay an exit load, which is a fee charged by the fund house for early redemption of units. The exit load of the fund is also mentioned in the offer document and it varies depending on the fund and the holding period. Closed-ended funds are those that do not allow you to buy or sell units after the NFO period is over. These funds have a fixed tenure, after which they are either redeemed or listed on the stock exchange. These funds offer low liquidity and flexibility, as you cannot exit the fund before its maturity, unless you sell your units on the stock exchange, which may be subject to market risks and price fluctuations. However, these funds do not charge any exit load, as they are meant for long-term investment. Interval funds are those that combine the features of both open-ended and closed-ended funds. These funds allow you to buy or sell units only during specific intervals, which may be annual, semi-annual, or quarterly. These funds offer moderate liquidity and flexibility, as you can exit the fund during the specified intervals, but not otherwise. These funds may or may not charge an exit load, depending on the fund and the interval. You should choose the fund that suits your liquidity needs and investment horizon. You should also consider the tax implications of exiting the fund, as different funds have different tax treatments, depending on their type and holding period. So, these are the 3 questions that you should ask before investing in any NFO. Remember, NFOs are not necessarily better or worse than existing funds, they are just different. You should do your own research and analysis before investing in any fund, and not get swayed by the hype or the marketing. Investing in NFOs can be rewarding, but only if you make informed and rational decisions. I hope you found this video helpful and informative. If you did, please like, share, and subscribe to my channel for more such videos. Also, don't forget to hit the bell icon to get notified of my latest uploads. Thank you for watching and happy investing.